Welcome to the 2024 updated Handyman Pricing Handbook. I did put out a 2024 pricing guide, I think in January or maybe even December of last year, but I've got a lot more questions, so I've put this into something like a classroom PowerPoint format. We're going to go through everything step by step, and we're going to try to do as comprehensive of a class as we can on handyman pricing. This is the #1 most asked question. It's also the hardest question to answer, but I've done my best here to break it all down for you in little steps that you can understand so that you can figure out how you're going to price and what you're going to price. So section 1 is going to be 8 categories of pricing structures. Section 2 is going to be 6 different invoice or payment strategies. Section 3, probably the most important one, is how to determine your actual rates. And then we're going to do some additional considerations and fees to think about. And we're going to talk about the free downloads, including this PowerPoint right here. Actually, you'll be able to download, and some other pricing documents that I have available for you to download. In fact, before we get to the end, I'll tell you now, if you go to the description of this video and you click on the link, should be at the very bottom. That's going to take you into a process where you can download all of my free documents. And in that is one called Handyman Jobs with Pricing. Another one is my CSV files. If you use Jobber, you'll be able to download all of my pricing files and upload them into your Jobber account. And then number 3 is this actual PowerPoint here you'll be able to download. So if you want to do that before we start, you can. Otherwise, let's go ahead and dive in. All right, so we've got 8 categories of pricing structures. I do want to be clear on all of my videos. Anytime you hear me talking about how much I'm charging for a job, I'm only talking about labor. I'm never ever talking about materials. Materials cost whatever materials cost at the time that you buy them. You may or may not mark up materials. We might talk about that a little bit later, but regardless, the materials just are what they are. So when we're talking about pricing, we're always talking about how much are we charging for the actual labor, for the running of the business, for the fixing of the items. And with that being said, we're going to start off with my least favorite one, which is flat hourly pricing. I'm not a fan of flat hourly pricing, but we're going to go on to a different slide for each of these, so I'm not going to dive into all of them. Then we're going to talk about hourly plus a minimum, which at least isn't hourly, but there are still some issues with that. We're going to talk about having trip fees plus hourly, or trip fees plus fixed prices per item. We're going to talk about fair market value pricing, which I think is my favorite. Then we're going to talk about fair market value pricing with a maintenance limit to cap it so it doesn't go too high. We're going to talk about doing only firm estimates, and we're going to talk about cost plus. And one thing I'll throw out before we dive into each of these categories and start breaking them down is it's very likely your business isn't going to run off of only one of these pricing structures. You're probably going to be using 2 or maybe even 3 of them. Heck, you might even use all of them, but you're probably going to use 2 or 3 of these pricing structures. And this is the breakdown for you. So let's move on to flat hourly. So under flat hourly, I've got some pros and cons. Number 1, it is predictable income. That's a nice pro. You just know that if you've scheduled 3 hours and they've agreed to 3 hours, you're going to show up and work 3 hours and you'll get paid for 3 hours. So you do have at least some predictable income. It's also minimal admin work because you don't really have to think about much. You're just giving a quantity of hours and sending an invoice. And of course, it's extremely transparent, so there's no question as to what you should or shouldn't have charged. You worked the number of hours you worked. Now, the cons on flat hourly, and there's more than the ones I have listed here, but the main cons are number 1, limited income potential. If you're charging, call it $100 an hour. If you're charging $100 an hour, you can't make more than $100 an hour. You will never, ever make more than $100 an hour for your own time and labor if you're charging $100 an hour. So you've capped your income right out of the gate. The number 2 con for hourly is that you kind of give yourself employee status, because when people hire you by the hour, they kind of assume that whatever it is they'd like you to do for that hour is what you should be doing. So they want to act more like your boss than a client that you're doing a job for. Now, I think the worst part about charging hourly is that it penalizes efficiency. And what I mean by that is, let's say you change a faucet and it takes you 2 hours and you're charging $75 an hour. So that's a $150 job now. That's the value of that completed job to that client if they're happy to pay you $150 to change their faucet. What happens when you get faster and better, when you get better tools, when you get processes down and you've just got more experience? The better you get, the faster you are. So that 2-hour job for $150 is now a half-hour job. And maybe you've got a 1 hour minimum, which is great because at least you're now going to make your $75, but you're no longer making that 150, and it's still worth 150 to the client, but they're not going to pay you for 2 hours of work if you didn't do 2 hours of work and you told them that you charge $75 an hour. So the better you get at your job, if you're charging hourly, the less money you make per job as you improve in your skills. And I know you're thinking, okay, well, I'll just raise my rate to 150 an hour and charge that 1 hour minimum. Well, that's great, except now you're 150 an hour. So when they ask you how much do you charge, and you say 150 an hour, and somebody else tells them that 75 an hour that you used to be, well, they're going to hire the $75 an hour guy because they feel like you're charging too much at 150 an hour. So there's really no way out of this conundrum. If you're charging hourly, you're always, always, always going to be limiting your income potential, and you're going to be building a client base on an hourly rate that you're not going to be able to maintain in the long run if you want to make good money at this. Let's move on to the next slide. And we've got hourly with a mandatory minimum. That's the one I was just talking about. So for hourly, one of the fixes, like I said, is introducing a minimum. The good news is it helps fill your schedule, because if you have that hourly minimum, then at least you know how many hours they're booking you for, so you can get your schedule filled out quickly. And if somebody, let's say, pretend like you have a 3 hour minimum now, you're going to be 75 an hour with a 3 hour minimum. So when you go in to book your day, maybe it's only a 1 hour job, but since you're charging a 3 hour minimum, you can go ahead and show up on that job and know that you're getting paid for 3 hours out of that day. And it also limits drive time. It limits drive time because chances are, if you have a 3 hour minimum, they're going to find a way to keep you busy for 3 hours. So you're not shooting all over town all day long every single day. But that's not a really huge benefit there. The cons on this, however, are that if the client doesn't make you stick around for that entire 3 hour minimum, now you've got clients paying you for hours that you didn't work, and that's not going to make a happy client. But I can tell you from experience, because I was doing this once a very long time ago, I can tell you from experience, if you have a 3 hour minimum or a 1 or 2, doesn't matter. If you haven't worked every single minute of the number of hours that you told them was your minimum, they will find work for you to do. So instead of being productive and doing things that really need to get done, getting more clients, building your business, building your client base, instead of that, you're going to be doing really menial labor on someone's house, moving boxes. They might even set you to clean in the bathroom. You never know. So I really don't recommend any sort of pricing that has anything to do with hourly. Moving on to the next slide is trip fee plus hourly. So this one includes an aspect of hourly still, which I'm not happy with, but we've now got a trip fee in place. So instead of having a minimum number of hours, now we've got a minimum payment to show up on the job. So we're not going to be in a position where the client thinks they either have to pay us for hours we're not working, and they're not going to be trying to set us to work on a bunch of menial tasks. But the pros is at least it's not just hourly. That's really a pro. I mean, the further you can get from hourly, the better. Another one of the pros is it covers your drive time, because that trip fee is that's the money that you're charging them to show up at the front door. So just to get to the house, all the work you do after you get to the house is on top of that. And you can do this in a different way. I have done this where the trip fee includes the first hour worth of work. Later on, the trip fee ended up just including about 30 minutes worth of work. And now the trip fee doesn't really cover anything. If I wanted to cover the work, like let's say changing a faucet, I typically change a faucet for $150. So the trip fee is $125 of that. The faucet technically is $25, but I don't present it that way. What I do is I just change the faucet for $150, but we'll talk about that more when we get to the fair market pricing. For now, what we're going to call our trip fee is the money you charge just to show up to the front door, and then you're going to charge an additional amount of money, which is going to be hourly. So you're going to say trip fee $80 plus $40 an hour. That's not the pricing I recommend you to be at. That's just my example here. But $80 to show up at the front door plus $40 an hour. You're probably going to say it's a 1 hour minimum. So you're going to be now at $120 to show up and do up to an hour worth of work. It's not a bad deal. However, what you're going to find, well, actually, I'll wait till I get to the cons for that. So at least it's not just hourly. It does cover your drive time and your gasoline to get to the front door. That's what that whole trip fee is. And it does incentivize efficiency because even though there's an aspect of hourly still involved here, you're now in a position where, because of that trip fee, the faster you can get these jobs done, the more trip fees you can rack up for the day, and that is a really good way to be profitable. Now let's talk about the cons for trip fee plus hourly. Number one is because it still includes an aspect of hourly. Number two, it's less profit on big jobs, and that's the one I was about to get to a second ago. The problem is that if you're charging a trip fee plus hourly, your hourly rate is going to be lower than if you were just charging trip fees or using a lot of other methods. You're going to need that lower hourly rate to accommodate those small, quick jobs, which is most of what we're going to be doing. But now if you have an 8-hour job, you're working 8 hours at that really lowered rate. So you're going to make less money on big jobs than you could have if you weren't doing trip fee plus hourly. And then finally, it puts you in a position where you're kind of overcharging on small jobs. Because like I said, if it's just a smoke detector battery, and let's say you've got $100 trip, let's say you've got $100 trip fee plus $50 an hour. So now you're at $150 just for that smoke detector battery. So that structure doesn't work really well to accommodate both small jobs and big jobs. And moving on to the next slide. On this one, we've got trip fee plus fixed price items. I do like this one a lot. This is very similar to a lot of the jobs I do. This is one of my many methods that I use for pricing. So what this is you're going to have a trip fee that covers you getting to the front door. This one is more handy for bigger jobs. But the trip fee covers you getting to the front door, covers your admin work, parts ordering, invoicing, estimating, shopping, all of that stuff. That's what the trip fee covers. And then instead of hourly for all the work that you do above and beyond getting to the front door, instead of hourly, you've now got fixed prices on all or most of the things that you do while you're there. So for example, if I do a sink pop-up stopper, I'm always going to charge, I think my pricing, you could look at my line items because you can download those. But if you look at my line items, I think I'm charging like 45 or 55 bucks or something for a sink pop-up stopper. So that means that I'm incentivized now to do it faster because I put a fixed price on it. If it's 125 to get to the front door, and then it's hourly after that, there's no incentive for me to do that pop-up stopper quickly. But if it's a fixed price that remains the same every time I do it, now the faster I do it, the more money I make. So I wake up in the morning motivated to get out there and get as much work done as I can, which makes my property managers and my clients overall happy, and I make more money the faster I get. So I really, really like this one. The first one is incentivizes efficiency. Second one is it covers all your costs, right? Because it's definitely going to cover the cost of getting to the front door. And if you've set your line item pricing correctly, it's going to cover the cost of working on the line item. Another great thing is uniform pricing. If you have long-term clients who do a lot of business with you, this whole channel that you're watching right now, this is mostly about property management. This is working for property managers of single-family homes, not of apartment complexes. And we're not talking about slumlords either. We're talking about big companies that have lots and lots and lots of spec homes. Things break all the time. They don't want to chuck in a truck. They want a business that can go out there and handle their problems quickly. They are willing to pay a premium for that when you get good at it. So this is very good for the uniform pricing because now your property manager can kind of predict what you might be charging for that job before they send it to you. And that makes them really comfortable. And then also there's minimum admin work. In fact, let me talk about, I've got this big arrow right here. That's to remind me to tell you all about my custom line items you can download. They're free, no paywalls on this channel anywhere. Everything I offer is for free. Nothing's behind a paywall. That's just my policy. If you click, like I said at the beginning, at the bottom of the description in this video is a link to get my free documents. One of the things in that link when you get my free documents is a file that's going to be called CSV file, and it may say custom line items on it. And what that is I have all these custom line items, about 100 of them, for all these different jobs where I'm going to charge the same amount for this job every single time I do it. So when I'm writing estimates or when I'm writing invoices, instead of having to type everything out, what I do is I can just go in there, type in the first couple letters. It's going to pop up automatically and autofill and filter down. I click on the one I want, and then I click on the quantity, adjust the quantity, boom, move on to the next line item. So you can download my custom line items, and if you use Jobber, you can upload my custom line items into your Jobber account, so you will be starting off right off the bat with my actual custom line items that I use in my business. And I don't suggest you use them exactly the way they're written and exactly the way they're priced. Mine are written for my region, my property managers, my business style. They're priced for my region, my property managers, my business style, my average level of income of the homeowners that I do work for. So don't just download mine and use them, but do download them and edit them to match your business. I think that's a really, really big benefit y'all can get from me. And then, like I said, there's also a spreadsheet in there to help you figure out your own prices on your individual items. So what are the cons of trip fee plus fixed price items? Well, one of the cons, and you're not necessarily stuck to it, but one con can be, is that it limits your options in terms of how complex or simple your jobs are. What you kind of need is for some standardization, which you can get in the rental world. Now, you can also just go ahead and deviate from your fixed pricing if you have clients that you can talk to who understand that a lot of things are different. But I guess what I mean by this is, let's take faucets are still another good example. I use a particular faucet that I put in nearly every rental home I work on. If it's not a slum, and if it's not a multi-million-dollar mansion, every home I work on gets the same faucet. I use this faucet because it comes with the supply lines already attached. It has the same hookup method every time. It's really fast to hook up. And I've got that particular faucet down to a really great process that makes me super efficient. However, let's say you're working for homeowners and they want to pick their own faucets. It's harder to have that one fixed price line item for your homeowners, because there are faucets out there that can take an hour and a half to install that don't have a really great install system like the ones that I use. So it's going to limit you a little bit, or you may have to deviate. However, like I said, if you're working on rentals for property managers, most of your homes are going to be in about the same value range. They're going to be average spec homes in the suburbs, and you're just going to throw the same faucet in every single house. There will be very few exceptions to the rule. And when you do find an exception, like I said, you could just go ahead and deviate from your system and communicate as to why you did. And then the other thing it does, if you were to try to be only trip fee plus fixed line items, which you're probably not going to be, like I said, you're going to be 2 or 3 of these methods sort of hybridized into one. But if you tried to do trip fee plus fixed price line items across the board, and that's the only way you'll do business, one of the problems you'll run into is you now can't take on any work that can't have a fixed price attached to it. And a lot of the work that gets requested of us, whether we like it or not, is going to be very custom work. It's going to be really weird situations that's just going to require you to get up in there and just start working on it, not knowing how long it's going to take until you get halfway into it. So those are hard for fixed price items. But like I said, you can submit estimates, or you can use some of these other methods for that. And moving right along to the next slide is my favorite. It's what I mostly operate off of. The only time I'm not operating off of what I call fair market value, the only time I'm really going to deviate from this at all is when I'm doing firm estimates, or when I'm doing my trip fee plus fixed price. So fair market value, I would say, is about 80% of how my business does its invoicing and its pricing. And what this means is, as I was mentioning before, at the end of the day, there's a fair market value to any particular job. So if you need a new faucet installed in your kitchen, there's a value that the client is willing to pay for that. That's within a window that doesn't screw you out of money and doesn't overcharge them for anything. There's going to be that window, and the value of the job is within that window. So fair market value pricing means it's not a trip fee, it's not a trip minimum, it's not hourly, there are no fixed prices. It means that you, as the provider of the service, have a very in-depth understanding of what the value of the job is, and you're simply going to do the job, and then you're going to charge whatever the value of the job is. So the benefits, of course, is it definitely always covers costs plus profit, because you get to decide what that number is. So you would have to decide to not reimburse yourself for your cost and your time and your profits and everything. You'd have to make that choice for that not to work. It's also, another great pro is unlimited work scope. You can do any job you want if you're just going to decide what the price is when you're done with the job. And then finally, it is infinitely flexible. And I guess that's the point that this keeps getting to. Fair market value is infinitely flexible. It simply means you're going to charge whatever you want to charge, except it's not about what you want to charge, it's about what you actually know to be the fair market value of that work. Now, there are some cons on this one of which is it requires experience. You can't charge fair market value for a job if you don't have enough experience with having done that job to know what that fair market value is. You're not going to get that off of any online resource. You're never going to find out what that fair market value is until you put yourself out into that market, charge different rates, experiment with your pricing, feel where the pushback comes in when people don't like the pricing and they start saying no, feel when people start saying yes way too quickly and being too happy with the pricing until you get to that middle ground. But once you do find that middle ground, it's really great because then you just get more and more efficient and you continue charging whatever the value of the job is. Another con is that it requires discipline, and it really does, because here's the thing, guys. When you're doing fair market value, because you are going to charge whatever you want to charge when you're done, because that's the situation, you're going to be tempted to charge more than you should be charging. And the danger here, especially with repeat clients over time, is if you just start adding to how much you charge, if you just increase that over and over and over with no consideration to what the actual fair market value is, you're going to start losing clients. They're going to start getting a bad taste in their mouth when they see that you're literally charging what you want rather than what the fair market value is. So it requires a lot of discipline on your part. And you might have a job that goes bad, like a faucet. Say you decided the fair market value for the faucet is 150, and you have one particular faucet that takes you 3 hours because everything was rusted on, it was impossible to get to. You had 18 different problems rear their ugly head while you're working on it. You're going to be tempted to charge $300, and you can. If that's the fair market value, by all means, go ahead and do that. But I think where the discipline comes in for me is sometimes I have faucets that are literally 15 minutes. I'm in and out and I make way too much money. And what I do is that means when one takes me 3 hours, I'm still just charging my 150 because this gives them uniformity and predictability and it makes them feel safe doing business with me. But the discipline comes in where you have to stop yourself from charging more money when you really would like to charge more money for a job. And then finally, there's a limited client base. Good luck finding clients who are going to be willing to pay you whatever you decide. Typically, you're going to have to start out with them on a different type of pricing structure, and over a year or two, sort of ease your way in to just simply charging the fair market value. It can be done. It's how all of my clients work with me. None of my clients have any agreements with me on what my pricing structure is. They are aware that if they send me the job, I'm going to get it done and I'm going to charge a fair price because I had the discipline to charge that fair pricing for the last 4 years of this business. And moving on to the next slide, we have fair market value plus maintenance limit. And this is going to help you overcome the scenario where they don't want to just let you decide what you're going to pay. So what I have set up with my property managers, and they subsequently also have set up with their homeowners, is what we call maintenance limits. And this is where you're going to charge the fair market value, but there's going to be a cap on it. So most of mine, there's a cap of $350 if it's not an emergency, which means if it's under $350, I'm going to charge whatever I feel like is a fair rate up to $350, but I'm not going to do any work over $350. And oftentimes what that means is if I have a small punch list, say 5 items, then I'm going to do 3 of those items. I'm going to charge $327. And then I'm going to send an estimate for the rest or request a new work order with a new $350 maintenance limit for the rest. The pros of this is really great for scheduling efficiency, and here's why. Let's say you're charging about $100 an hour. Not that you're billing hourly, not that you're presenting an hourly framework to your client, but for your own internal purposes, you're trying to make sure you're at $100 an hour. And let's say that we're all on the same page. Materials are typically, let's say, 30% to 50% of the cost of any given job. So what that means you can do is any given job, if you schedule yourself 2 hours for that job, then you're going to know going into it that you're going to be charging $200 in labor and you're going to have $150 left for materials. And you know that, so if there's like 8 items on this punch list, you don't have to worry about scheduling and not knowing ahead of time how long it'll take you to do all 8 items, because you're not going to do all 8 items. You already know in advance that you're only going to do up to $350 worth of work, which is probably going to be 2 hours or less worth of work. So you just schedule 2 hours. It's very easy. And then whatever is remaining on that, the next time you're going to schedule 2 more hours and 2 more hours until you get it all knocked out. Or you're going to submit an estimate and they'll approve the estimate for like $800 worth of work all at once. But it's really great for scheduling purposes. And it means if you have to break these jobs up, then now you're getting more trip fees. A lot of our income comes from the fact that we're on a trip fee sort of business model, because that means the faster, more efficient you get, not only the more work you're billing for, but the total quantity of jobs that you can do. When you get faster and faster, you open up time over at the end of the day to add an additional job to the end of the day. So now you're doing more jobs per day, same amount hourly, but more trip fees to add to the books. So what are the cons on this one? Well, one of the cons is it's multiple trips per property. And the only reason that that's a con is simply because for your clients, especially if they're property managers, your clients want to see work getting done as fast as possible and things being on the books the least amount of time possible. And if it's further away, then even though you are getting those trip fees, now you're making more and more driving time to get any particular job knocked out. That means your clients ultimately in the end are paying more. So it's a pro for you that you're charging more, but it's a con for your clients because they're paying more. And anytime you can have them paying less while still making a great amount of money yourself, that's preferable. Another con is additional scheduling. This is because you have saved time. There is more efficiency because it's easier to schedule, but the quantity of scheduling per work order is going to go up because you've now had to break it into multiple jobs, which means you've had to schedule multiple times. And there's additional admin work that goes with that because now you're creating new jobs in your software more times for the same property, for the same punch list, and you're invoicing more jobs and you're signing off more receipts as paid. So these are really tiny cons, but they are the cons that really just juxtapose the pros. So in the end, I think it's a wash, and I think fair market value with a maintenance limit is a really great way to go. And moving on to the next slide, we have estimates or fixed price. This is two different sort of worlds, but I'm going to mesh them into one. Estimates is simply means that you're going to go there, or maybe they're going to send you pictures and videos. But when I say estimates, I mean firm estimates. And what I mean by that is you're going to give them a price, and that's going to be the price, and you're going to do the job for that price. And everyone is in agreement beforehand. So your price can still be the fair market value price, but you're going to get it in writing beforehand and get it approved beforehand. And then fixed price, very, very similar. It's almost, if not always, but almost always, if not always, going to include estimates that are approved beforehand. But the fixed price, what I mean by that, and the way that you'll hear this term used in the industry, fixed price is kind of like, let's say you're a painter and you're going to do exterior paint on a house, and you're going to charge per square foot of the house, or per linear feet of exterior wall space, or per square foot of wall. Same thing with carpet. Maybe you're a carpet installer, you're going to charge materials separately, and you're going to charge for a certain type of carpet $2 per square foot for the total square feet of carpet. That's a fixed price system, which may or may not include estimates that get approved. But this way is really nice because, well, number one, flexible income, because you're getting it approved in advance. If you have too much work, then you can give a higher price, thus sort of incentivizing them to say no if you don't want to be working so much because you're already sort of inundated with work. Or on the same hand, if you really want more work and you want to incentivize them to say yes, you can give them a lower price. So it's very flexible with your income. It also adjusts with the market. You're not stuck with that price forever and ever. You can change your fixed pricing over time, or with your estimates over time with inflation and everything, you can just be charging more over the long course. And it's extremely transparent. And I think that's the number one pro for this, is everybody is in agreement in advance on what it's going to cost. Now, the cons is it's a little heavier on admin work because you are typing everything up in advance and sending it back and forth to get it approved. So it can be heavy on admin work, but not too much. However, there's little room for mistakes. Once you've set that fixed price and you said, I'm going to do it for that fixed price no matter what, all of the mistakes that you made, and these mistakes can be actual mistakes, like maybe you cut a carpet too short and now you have to go buy a whole new roll of carpet. That's a pretty big mistake, and you can't change your pricing. But a bigger type of mistake is the meticulous planning section, which is the next little bullet point I've got here. They're kind of one and the same. The mistakes happen oftentimes in the stage of planning. So what this is if you don't check everything extremely thoroughly. This isn't just for flooring. This could be for cabinet replacement. This could be for removing walls, for moving electrical outlets if you're certified to do that. If you didn't check in advance and make sure that you have foreseen everything that could possibly go wrong and gone out of your way to check and see what the status of everything is. Are the walls straight? Are the corners 90 degrees? Is the floor level? All of these different things, if you don't check them well, can really, really, really mess you up when it comes to your pricing, because once you've got an agreement for that price, that's a legal contract and you need to do it for that price. That's also going to affect your reputation. So it does require very meticulous planning for you to not accidentally come out losing money at the end of that job. And it's travel intensive. If you have to travel to these jobs to actually do your estimates and to give your fixed pricing, you have to do a whole lot of traveling. And I highly recommend that if you're going to give estimates, most of the time you should stop by the job and look at it in person, because if you're trying to go just off of data and photos and videos, there's just only so much you can see in those. Next slide is going to be cost plus. This is where a lot of contractors operate, and this is not a bad place to be. Cost plus, what this means is you have an agreement in advance that you're going to charge X amount of dollars, usually per hour, for the hours worked. And this is usually for when you're subbing a lot of work out. But cost plus, whether you're doing it yourself or subbing it out, is you've agreed to an hourly rate for you, an hourly rate for your subcontractors or your helpers. You've agreed to a certain type of pricing on materials that may or may not include a markup. And then at the very end of all of this, you just simply add up your hours, you add up your materials structured pricing, you get a total number, and the plus in cost plus is once all of that is done, there's an agreed upon percentage that's going to be tacked on top. It might be 15%, 25%, 30%, it might just be 5%, but you're going to bill hourly and you're going to bill for materials. And the plus is just the plus my profits. So you're going to have an agreement for the profits in advance. Like I said, this is a really common way that a lot of contractors work. I highly recommend you do get your contractor's license, whether that be general or whether that be a specialty license. I recommend getting your license. Cost plus is a nice way to work. I don't really like the hourly that gets involved with it, but it's a guaranteed profit. And typically, well, let's just go into the pros and cons. So the pros are all of your costs are covered, like I just said, and profit is always guaranteed, like I just said. The cons are the meticulous record keeping required. You're going to need to prove, when you're in this kind of structure, you're going to need to prove the total number of hours involved. And this may also include admin hours at the office. If you have any office staff, this is going to need to include driving time. You're going to need to document that. It's going to need to include your subcontractors and your helpers. It's going to include a lot, and you're going to need to track and prove every single piece of this. So it's very, very meticulous with your record keeping, and it is very easy to get complacent on. And what happens with the complacency is, because you know that everything is guaranteed, because you've got profits guaranteed and you've got an agreement in place that your client is going to pay that hourly fee for everybody you send to that job, as well as yourself, it gets really easy to not worry about efficiency because your income is guaranteed. And when you stop staying on top of efficiency, your people are going to get inefficient, and you may even get complacent yourself and get inefficient, even if all you're inefficient about is keeping up with your people's efficiency. So it's super easy to get complacent. When you get complacent, you get expensive. In today's market, that might be okay, but today's market is not forever. So you want to be very careful on this pricing structure that you don't get complacent and let the cost of your projects rise so high that you start getting lots and lots of angry clients who did not expect the cost that they ultimately ended up with. And we're going to move on to the next section, which is 6 invoicing payment strategies. You can do retainers, you can do subscriptions, you can have payment due upon completion. There's also net due, which is extremely common in my field. You can require deposits, or you can have payments when you hit milestones. So let's bring up milestones real quick. Sorry, my bad. The first one is retainers, not milestones. So let's talk about retainers. So what's a retainer? A retainer is an amount of money that's given to you in advance before you've done any work. And as you do your work, you're going to pay yourself from that retainer as you do the work. This is mostly for bigger jobs. Let's say somebody wants the vast majority of their house remodeled. And let's say that you are both qualified and licensed to do that. And this is going to be $60,000 over the course of 6 months. And one of your caveats for getting started is going to be a $5,000 retainer that gets replenished back up to $5,000. Let's say every time it gets down to $2,000. So you get your retainer, you get your agreements in place, and you just get started working. You go over there and you start tearing stuff out, you start putting new stuff in weekly or however often it is that you've decided that you've got an agreement on. You're going to add up all the expenses, all of the labor, everything else. You're going to pay yourself out of that retainer, and then you're going to give them a balance on their retainer. When it gets back down to $2,000, or maybe when it gets to zero, however you want to work it, then they replenish that retainer in order for you to continue doing work. And this guarantees that you don't ever do any work that you're not going to get paid for. It's very similar to the milestones method. So you get your lump sum up front. It's mostly good for larger projects. It's also for high quantity clients, and it's also for wealthier clients, because it's the wealthier clients. They just want somebody reliable that belongs to them, that's going to be dedicated to their project. And the wealthier clients are going to be more willing and more able to pay that retainer and feel confident that they're going to get their money's worth out of it. Wealthier, or not wealthier, but premium business clients kind of up the same road, and it's going to be in high demand markets. So basically what I'm saying is retainers, they're harder to get. People aren't going to want to give you a lot of money up front for work you haven't done without a very well established relationship with you. But like I said, if they're wealthy, if it's a high demand market and there's not enough guys around to go around, and they really want their own handyman who's going to be dedicated to their project, you might be able to pull a retainer type situation. And moving on to the next slide, we got subscription model. Now, I'm going to tell you up front, I've never done a subscription model, nor do I know anybody, even everybody on this channel. A lot of guys ask me about it, and I always tell them, I just don't know, but please let me know if you do it and it works out. So I hear a lot about it, but I have no personal experience. But this is going to be a monthly fee, with or without any service actually happening. So they're going to sign up, and maybe they're going to pay you $50 a month every month. And that's just going to sort of go into an account for you. And they're going to build up a balance that sort of you owe them in services. And then when they need your services, because they already have that balance, you're going to go over there and perform the service they need and deduct it from the subscription. It's kind of like the retainer, just not quite so much money. But the client accrues value in their subscription, and maybe they're using it up monthly, you never know, but they accrue value over time, and then you do the work and pull it from whatever they've paid you. Maybe you got to charge a little extra on top. They get priority service. Technically, that's going to be part of the subscription model. Again, it's very similar to a retainer in that what they expect, because they're paying you monthly, is that when they need you, you're going to show up quickly. So you don't want to have a subscription model going on if you're also providing like remodels to people who also expect you to be there daily. Usually they're combined with discounts. When you're doing a subscription model, you might say something like $50 a month worth of credit for $45 a month worth of payment, but they're going to get some kind of discount to incentivize them to be giving you that money on a monthly basis. And it balances your revenue over time. That's, I think, one of the best pros of the subscription model, is if you have enough of them, then you basically have a guaranteed amount of work or a guaranteed amount of money coming in on a monthly basis on a routine schedule. And then it's just your job to manage your actual schedule working on these houses. But keep in mind, you definitely don't want to put yourself in a position where you take on more subscriptions than what you can handle in work. Because you have to remember, you're going to get a surge of work in the spring. You're going to get a surge of work maybe not during the holidays, but right before the holidays. Or if you live in an area like where I'm at, where we have monsoons, there's going to be a surge of things that get damaged when the monsoons hit every year. So you got to be really careful, but it does balance your revenue over time. And then limited use cases. What I mean by limited use cases is you can't have somebody paying their subscription fee, assuming that they're going to get priority service, and then they say, I want a whole brand new kitchen. You can't accommodate a whole brand new kitchen on a subscription model, because you've got these hundreds of people paying their subscription that need you responding to things daily. So you do have to specify exactly what services are and are not included in the subscription model. And that doesn't mean that they can't also hire you to remodel a kitchen, but they can't be expecting that they can apply their subscription money and their priority access to you for really big projects that you can't just stop what you're doing and go take care of. And moving on to the next slide, upon completion. This is a super common one, and all this means is that they have an agreement with you, you have an agreement with them, that when the job is finished, that's when they owe you the money. So it's not some later date, it's not milestones throughout, it's not retainer or anything else. It just simply means when you finish the job, they need to pay you. It's probably the most common. It's very easy to track, because you know when the job's done, that's when they owe it to you. You also don't have to go back later and figure out if they paid you yet or not, because they should be paying you the day that you finish. It is limited to clients with cash on hand, so this is not going to be for example, commercial customers or for property managers, generally speaking. And there is a slight risk of non-payment on larger jobs. However, that's not really exclusive to payment upon completion setups. There's always a risk that somebody's not going to pay you at the end of a larger job, which is why we have some of the models like retainers and milestones and stuff. But let's go ahead and move on to the next slide. This is going to be net due. Net due is my biggest model. It's really my only model for the most part with my property managers. And net due, what that means is you've got an agreement in advance that when you submit an invoice, they need to pay you within a certain number of days. And for example, I am a net 30 company. And what that means is when I get on with a new client, I let them know that I'm a net 30 company. And if they agree to work with me, they're agreeing that their invoice is due to be paid within 30 days of me sending the invoice. And at the exact same time, they are a net 30 company or a net 15 or net 45. And the numbers just represent the numbers of days you have. So what you do is if you're a net 30 company, then you hook up with property management companies that are net 30 companies. Let's say you find a property manager you really want to work for, but they're a net 40 company or a net 45 company. This means they're not going to pay you for 45 days. So you have agreed by signing on with a net 45 company that they don't have to pay you until it has been 45 days. It does allow clients a lot of flexibility as far as payments with property management. They're typically waiting for rent to get paid next month to send you the money, or maybe they do have a slush account for that homeowner that they can pay you out of, but that account may not be big enough for certain types of jobs. So it allows them the flexibility to just send you all the work they need to send you right away without worrying about payment terms, and knowing that you'll get the work done and they will get the money to pay you within the number of days that you've both agreed upon in advance. It does require capital and cash flow on your end, because what this means is you're going to be investing a lot for work that you may not get paid for 30 days. So you have to have the cash flow and the capital on hand to be able to take care of all these jobs, pay yourself a paycheck, pay your workers a paycheck, purchase a lot of materials, and have that money not available to you for up to 30 days until you get paid for it. But it does smooth out the roller coaster quite a bit, because what ends up happening is as you get deeper and deeper into it and you're doing more and more work, you eventually find yourself in a position where you just kind of always have invoices that are paying out. You're invoicing a handful of jobs daily, and you're getting paid for a handful or dozens of jobs every 5 days, 10 days, 15 days. You've got multiple clients Some of them are going to pay out every Friday. Some are going to pay out on the 10th of every month. Some are going to pay out bi-weekly. Some are just going to pay out within 3 or 4 business days. So you end up with lots of clients and lots of different invoices that are just always dropping into your account at different unpredictable times. And it evens out that roller coaster, because if you have a really slow week, that's okay. You've still got invoices getting paid from 15, 20, 25 days ago. If you have really busy weeks, those are putting extra cash, kind of banking away extra cash that's going to come in later. If you get sick, if you have a family member die and you need to leave the state for a week, you don't have to worry too much, because everybody's paying out on different terms at different times. So you can miss that week and know that when you get back from that week, there's still invoices dropping into the bank that are getting paid every single week. And moving on to the next slide, the next one is deposits. These are usually 50%. I feel like I don't need to explain what deposits are. It's just where you say, yeah, I can do this job, but I'm going to need 50% down, or I'm going to need $500 down to cover materials, or I want enough down to cover all the materials plus half of the labor. However you want to work it. It's just simply where you require a deposit before you start the work. Do keep in mind, some states have caps on the deposits. A lot of states, California is one of them. I feel like it's maybe 10% in California, and I feel like this is a way that lobbyists have tried to squeeze out us smaller guys out of the system, where they've passed these rules and regulations over requiring 10% deposits, which means if I don't have the money in my business, if I don't have the capital to invest in advance, I can't even ask the client to give me the capital that I need to get started on the job if it's over 10%. It does require good financial management, because what this means is you're going to have a bank account that on any given day is going to have $4 grand, $8 grand, 12 grand, 32 grand, however big your business is. You're going to have these accounts that look like they're full of money, but that money is there to keep paying for things while the business runs, while the business waits to get paid later. So you have to have some discipline with your finances, and you have to understand that whatever's in the bank, that's not really there. It's not money that you can just go grab and use for what you want. And it eases the financial burden for the net due, because at the very least, you've gotten some money up front. So if you have a project that is going to take you a week and you haven't built up a lot of capital in the bank yet, you're able to take on these jobs and at least pay yourself something to get yourself by until you get to the end of the job and finish the job and submit your invoice and get paid. And it weeds out sketchy clients, because any client who isn't willing to give you a deposit on a job, let's say, again, you're going to remodel a kitchen, so you need to buy $10,000 worth of cabinets. If they don't want to give you a deposit to cover the cabinets and perhaps some of your labor up until the point the job is done and you get paid in full, those clients are pretty sketchy anyways. Those sound like the kind of clients to me that are going to try to not pay you the full amount when you're done. So it just kind of automatically weeds out a lot of those sketchy clients if they have to give you a lot of money up front. And for the clients, honestly, it's going to have them weeding you out. So if you're not presenting a professional image, if you don't have them convinced that you're a reliable company to go to for the work that they've requested, if that's not the image you've presented, they're not going to want to give you that 50%. So it doesn't always mean that it's weeding out bad clients. It could be that it's weeding you out, and you need to do some things to fix your end of the business to give them that confidence in giving you a 50% deposit and feeling like you're going to actually finish the job properly. Moving on to the next slide, milestones. This one you're going to find more with contractors. Milestones usually for really big jobs. This could be a whole brand new house build. This could be a full home remodel, or any number of other big jobs. But milestones, very similar to deposits, is they're going to owe you a certain amount of money up front, some sort of very large down payment that's there to cover a giant bulk of the materials and a lot of the labor. But instead of waiting until the job's done to get the rest of the money, you're going to set these milestones. So you might require 50% down of the whole job cost right off the bat. But then instead of the other 50% upon completion, you might get 15% when you hit the stage where you've gotten all the old cabinets ripped out and some self-leveler put on the floor and whatever else done you needed to get done for this cabinet job before you put new cabinets in. And then that's a milestone, and you get 15%. And then when you get all the cabinets in and you haven't done any countertops, you haven't done any plumbing, there's still plenty of work left to do. But once all the cabinets are installed and attached to the walls, then you get another 15%. And you go this route all the way through until the end, and you break down the milestones as the job progresses so that you can continue being able to pay yourself and or your subcontractors and helpers throughout the job. It does require exquisite project management skills. You really need to know how these jobs are going to flow, because if you mess up and you don't have a payment scheduled at a time when you need that payment, now you don't have any money and you can't continue working without going to the client and asking them if you can break the contract and ask for more money in advance. So you have to have really good project management skills, but it does create a lot of trust between the client and the vendor, because as you reach each milestone, they see that you've agreed they see that you have held up your end of the contract. You finished that particular portion of the work up to that milestone, just like you said you would. They can look at the quality, they can pay you. Now you're very comfortable with them because they've paid you, and they're very comfortable with you because you've gotten the work done. So it does help build a lot of trust throughout the process of working with that client. Moving on to the next slide, how to determine your actual rates. And we're going to use an example as we determine these rates, but keep in mind, this is only an example, and you're going to need to use your own methods and your own numbers for your region, your business model, your clients. You're going to have to come up with all of this on your own, but I am at least going to give you an example that you can follow to determine your own rates at the very end of this. Now, the one thing I want you to keep in mind as we go through this section is we're going to be talking about a lot of things on an hourly basis. Yes, I don't suggest that you talk to your clients about charging hourly. I don't think hourly is something that needs to be on their mind or in any of your paperwork. But in the end, our time is extremely valuable. It is our most limited resource. We cannot get more of it. So the ultimate question we have to answer is, when we give our time into this business, what is the reimbursement for us for the time and resources that we put in? Which is why we need to know, just in our own minds, what kind of compensation per hour of our investment we need to be getting back from the work that we're doing and from running this entire business. So what we're going to go over is we're going to go over the basic assumptions that we're going to start with, and then we're going to estimate our overhead, and we're going to estimate our billable hours, and then we're going to, especially, this is very important, accommodate the unexpected. We need to expect the unexpected. We need to understand that things are going to happen. Nothing is ever going to quite go to plan. That's just the nature of this industry. So we have to build in our buffers for these unexpected things at the beginning, rather than coming in at the end and asking for them to be made up for by someone who didn't think they were going to be paying for all of those unexpected things. And then finally, at the very end, we're going to add some kind of profit margin and or money to reinvest into the business. We're not here just to go work and get ourselves a paycheck per hour for the work we did. We're here to grow and build a business. So part of your charging, part of your rates does need to accommodate you growing your business and making some kind of profit. So we'll go ahead and open up the first slide, and here's going to be our starting assumptions, because this won't apply to all of you, but you'll still be able to use this method even if this doesn't apply. Assumption number one is that you're going to be an owner-operator. So this is not for somebody who's going to build like an Ace Hardware Handyman franchise and hire 12 employees and get 12 vans and 3 office staff. This isn't for y'all. This is for those of us who are self-employed. We're starting out somewhere near the beginning. Maybe we're going to hire a helper. Maybe we're going to have 1 employee, maybe even 2. Maybe we're going to subcontract a few things, but we're generally operating as an owner-operator. We're going to be doing it full-time. And again, this method will help you figure out what you should charge part-time, but the example won't apply to the part-timers. This is going to be medium-sized jobs. So we're not only doing the teeny tiniest little jobs, and we're not only doing the really large jobs, but we're averaging in the middle somewhere, where the jobs we're doing take, let's say, less than a day at the very least. Some of them will take a full day, some will take 3 days, some will take 15 minutes, but most of our jobs are going to take us an hour, 3 hours, 6 hours, but we're going to keep that confined within a day because that's mostly what you're going to find as a handyman if you're not remodeling whole houses and if you're not starting a huge business with a lot of employees. And this also assumes that we're operating as a legitimate business, which means that we have business liability insurance, we have professional liability insurance, we have a CRM that we're using for all of our scheduling and to manage our business. We've got QuickBooks so that we can keep track of all the finances. We're covering all of our bases and we're operating the way that you would expect a real business to operate. So this is not for the chuck in a truck who's just got some tools. He got a local business license. He's just kind of operating under the radar, doing half of his jobs for cash, not paying his taxes. This is not for y'all. This is for guys who want to start an owner-operator, real handyman business that they're then going to grow into something much bigger and more profitable in the future. We're going to go off the goal of 40 billable hours per week. And that doesn't mean we're always going to hit those 40. But when I say billable hours are hours that we spend on the job actually doing work. That's what I mean when I say billable hour. And it doesn't mean that you can't also bill for shopping time and for admin time and stuff. But my method and what we're going to go over here is we're going to bill, we're going to set up our rates such that we're figuring out what we're charging for the amount of time we spend on the job with tools in our hands to the clients that they're paying us, that they can visually see that we've done. And we're building in all of the external costs, such as shopping and admin work and stuff. We're building that, what we need to cover that, we're building into the billable hours on the job. Also, we're going to assume that our goal is to make 6 figures a year. And what I mean by that is to be charging for your labor more than 6 figures per year. So it should be even more when you add materials and other things, but we're shooting for 6 figures. And that may sound high, but it's not in this industry. If you set up your business properly, the way that this entire course and this channel teaches you how to do, there's literally no reason to not be at 6 figures a year after you've been in business for 1 year. This also assumes that we have a home office because you're going to need an office to run a business, right? You're not going to be running a business on your phone or like on a laptop with a couple spreadsheets. You're going to need an office because you're going to need to sit down and put a lot of time into running a business, not just fixing stuff. We're also going to assume that we want a retirement plan because, again, we're a legitimate business, and a legitimate business provides its employees with retirement plans and health insurance too, by the way, which is the next one. We want to provide ourselves with everything that we would have if we were working a 40-hour-a-week job for somebody else. So these are our starting assumptions, is that we're going to be an owner-operator, full-time, legit handyman business operating as any other business in the world would operate, and while providing us with a very strong, very nice paycheck and all the appropriate benefits that go along with that paycheck. Next slide, overhead. Now, this is not a comprehensive list of every type of overhead that you could possibly have. That list would be endless. However, this is a very good slide, though, for giving you the basics of what your overhead will be. You probably don't need me to, but I'll read it off to you. Your salary, your phone, your CRM, which is like Jobber that I use to run my business, tools, mileage on your vehicle, including gas, your accountant, your bonding. If you get bonded, I do think you should be bonded, even if you don't need to be. Even if you're not trying to be a contractor, you can get bonding and people like that. Retirement, taxes, and by taxes, I mean self-employment taxes, QuickBooks, business insurance, auto insurance, home office, every penny you spend on marketing, your website, your licensing, if you are licensed and you need to upkeep those licensings, QuickBooks, business insurance, home office, health insurance, and miscellaneous. These are some of the overhead items. You'll need to figure out what yours are, but if you get this list together and you know these numbers, you're going to be very, very close. Next, move on to the next slide. And what are billable hours? Billable hours are hours on the job. It's the actual work that you're billing them for, rather than all of the additional resources and expenditures that you incur while running the business that allows you to eventually get on the job and have those billable hours. We're going to be looking for 40 per week on the job of billable hours. We're probably not going to meet this most weeks, which is why we're going to add in some buffers later. But our goal, what will eventually get good enough to hit, is 40 hours per week at someone's house on the job with tools in our hands, fixing stuff. And just so you guys know, this means 80 a week in reality. When you include drive time, admin time, emails, talking to property managers, doing your taxes, keeping up with QuickBooks, and all of the other things that come with owning and running a business, you're going to be at 80 hours a week of actual invested time. If you consider any time that you put in to running the business, including just sitting down brainstorming new ideas, that's also time running the business, because it's not your time to go do what you want to do with, is going to be 80. So know that going into this. We're looking at, for all of the things that I just showed you, we're looking at $124,000 per year of overhead if we go off of my numbers that I've put together for this scenario. Each hour of work, therefore, if we're 40 hours a week, 50 weeks a year, that means each hour of work is $62 of overhead. So right away, $62 an hour. So that means if you were to charge $62 an hour, and this is while paying yourself. I believe that when I worked these numbers, I worked them out such that you're paying yourself, I think, $80,000 a year, if I'm not mistaken. And you can take these numbers up and down. But either way, this does include your paycheck plus all of those overhead expenses, because your paycheck is an overhead expense that the business needs to pay because it needs to pay you. You're now at $62 an hour just for 40 billable hours per week, plus paying your paycheck. And next slide is the unexpected. So if you schedule yourself for 40 hours a week worth of work, you're not necessarily going to actually, because what you're going to want to do is, let's say you want to leave the house in the morning and you want to come home in the evening, and when you're gone, you're going to be gone for 8 hours a day, 5 days a week. That's your 40 hours. You're going to lose a lot of that to drive time. You're going to lose a lot of that to all kinds of things, which is what this list is for. So inherent lost billable hours. This is 20%, and at the very least, this is drive time. And this number honestly should be higher, but 20% at the very least is just the time that you spend driving. But this is also when somebody cancels on you, or when you show up to the job, you get halfway through it and they tell you that they have to leave. They didn't think you were going to take so long, so now they have to go back to work. And a million other reasons that are things that are just inherently going to happen no matter what. So now that $62 an hour that we figured is the minimum we have to charge just to give ourselves a paycheck and have no buffer and just break even, we're going to add 20% to that. Mistakes and the unforeseen, they're going to happen. All kinds of things are going to go wrong on your jobs that you're not going to be able to charge more money for them unless you're hourly. It's one of the few benefits of just being straight hourly, but you're not going to be able to charge more money for them. So you need to build that into your pricing structure in advance to accommodate those. It's almost like insurance. Sick days and emergencies. You know, we did do 50 weeks a year. So we left 2 weeks a year for vacation time. But we didn't figure in anything for all the days that we're going to be sick and all the days we're going to have family emergencies, or maybe your AC on your house goes out and you have to spend 2 days fixing that yourself. So we're going to build in, I just made up 7%. That's off the top of my head, feels about right. But you got to figure out what your life is. How complex are things in your world, and how much time do you anticipate you might need to miss because of being sick or emergencies? You're going to have warranty work. I put mine pretty low at 5%. I could probably put mine even lower. We do almost no warranty work because we don't need to, because we do solid work. But you need to build in some structure in there to make sure that you're still getting your paycheck even when you have to go back. And this doesn't even have to be your fault. When I do warranty work, it's usually because of a materials failure, because something I purchased to do the job from a legitimate supplier at a normal price, not like cheap Amazon parts and pieces. But sometimes you're just going to have bad materials and you're going to have to go back and do that work under warranty. And then I put in there 10% for reinvesting into the business. And it doesn't have to be exactly 10%, but you do want to accommodate reinvesting money into your business. We're not here, like I said, to just work hourly and get a paycheck until we die. We're here to build a business, and you can't build the business without reinvesting back into the business. And honestly, that 10% probably could be even higher. And then we've also thrown in profit. So our profit I put at 5%. It could be 2%, 3%, 10%, but I feel like 5% is a reasonable amount of money to want your business to actually have as profit to go into the bank to be there, for example, for business emergencies. And just because, again, the purpose of a business is to grow, and part of growing is making profit. Final calculations. So we initially figured up all of our overhead expenses and assumed 40 hours a week on the job of billable hours, told us that we needed to charge $62 an hour to break even while giving ourselves a paycheck and retirement and health insurance and everything else. And then we're going to add 62%, all the percentages on that previous page. We're going to add 62% to that $62 an hour for unexpected profit and reinvestment into the business, which brings our total now that we should be billing per hour to $100.44 per hour. I did not come up with that number on purpose. That was mostly luck that it said 100, but I do use the phrase $100 an hour on this channel. I also, let me reiterate real quick, I don't think that's how little you should cost. I don't think that's how much you should cost. I just feel like if you're needing the answer of how much to charge, $100 an hour of the business billing for your labor is a good place to start. And then there are reasons to take that down and there are reasons to bump that up. But $100 an hour is just a nice, round, easy to remember, universally accepted number that most business owners who are successful, who didn't go bankrupt, they will tell you that $100 an hour is about where you got to be to really run a business, pay yourself fairly, and prepare for the future and grow and not go bankrupt. Now, for charging less, that might be because you're in a rural area, so you can charge less, you can schedule more tightly and more efficiently, and you can grow more slowly. There's lots of things you can do to bring that number down if you're in a rural area. And then the exact same thing if you're in a big city, you're going to need to bring that number up. But those are the final calculations. I just don't have time to dive into the actual cost of every single thing, but I gave you that list, and you can download this PowerPoint and you can start breaking that list down. So for the line for business insurance, get to that line, go online, get some quotes, get your business insurance, and add that number to your calculations. By the way, there's also a link in the description to get a quote from Next Insurance. It's who I've been insured with the entire time I've had this business. I really love those guys. I have a full business owner's policy with them, costs me $150 a month. It includes general liability, professional liability, and tools and equipment coverage. And I'm probably going to add my commercial auto to them and some other coverages as well. But please use my link in the description of this video to get a quote from Next. And if they're not the right one for you, don't purchase from them, but go get a quote from them. Moving on to the next slide. We have additional considerations. One is going to be materials markups. We could argue about this for weeks. Everybody has their opinions. I don't mark up materials any further than if I buy something for $9.78, I might just say $10. If I buy something for $98, I might call it $100. I might round up just a little bit to the next even type of number, the next round number. But otherwise, I do not mark up materials. A lot of guys do. In the end, the value of the job you do is the value of the job you do. So you can say $50 an hour, but mark up your materials 3x, which I don't think people are going to be happy with. Or you can just be upfront and honest and say, hey, it's $100 an hour. Not that you're giving hourly pricing, but if somebody wanted to break it down, I just feel that it's more honest to just charge for your labor whatever you need to charge and let the materials be what it will be. And people are just going to have to learn how to understand that it doesn't really matter. I can charge less for my labor and then add on to the materials, or I can charge just the price of the materials and add on to the labor. But in the end, you need a final price to get that job done. And that's what I consider doing for materials. But, if you want to mark up your materials, you can. Another consideration is charging more or less per skill set. So if you have the skill of electrical and plumbing, those are very high value things that you can charge more for. Also, if you have the skill for painting, that's a lower value thing. I don't mean you make less money. I just mean there are lots of guys out there who either can paint or at least claim to paint that are going to be competing for your jobs. So you can, if you want, charge less per hour, which you're not going to present as an hourly rate, but it is okay if you want to make less per hour for your time and efforts for low skill jobs and then make more for high skill jobs, as long as in the end you've averaged out to, let's say, that $100 an hour mark, or whatever number your calculations told you you need to be charging per hour. Another thing to consider is charging for estimates. This one I've been up and down on over the years. There's two sides to this coin. Number one is, if you charge for estimates, you're going to lose some work. There are going to be people who don't want to pay you just for an estimate, and in fact, they will be angry and upset and feel like you're gouging them. There are other people who are going to be happy to pay you for estimates because they understand the value of your time. What you need to figure out is who your clients are. You need to have some experience with them to where you can reach a point where you can say, hey, every time you send me an estimate, I put time and money into it, and then it never gets approved. So those are all unbillable hours. That's part of those percentages I was telling you you needed to add it to assume that you're not going to be billable 40 hours a week. Some of those hours are spent inspecting things and then coming home and writing estimates. So if your estimates are not getting approved, you need to charge for them. At the same time, if you have really great clients and it feels like every single time you do an estimate for them, they get that estimate approved and you get that work, you might want to consider never charging them for estimates, because they're bringing you lots and lots of really profitable business. Another thing to consider is community service. Most of this channel is about the business side, not the personal side. And a lot of people get the impression from my channel that I think you should be charging premium to everybody always without exception. Now, for me, that may be mostly true most of the time because I'm working for other businesses, not for people. However, I do sometimes work for people, and sometimes the work I do for the business is for people who have moved out of a residence, and I'm going to go do the move out, and they're going to get billed for the work I do. So it is okay to take into account on a personal level, not on a business level, however much good you want to put into this world, whether it be to just make yourself feel good about yourself, or whether it's for some unselfish reason. I'll be honest and admit that I like to help people because helping people makes me feel good. So that means whatever it means, but the end result is people get helped. But when you do that, you need to know going into it that this is not what your business is doing. This is what you're doing as a good person to help other people out. And this may be donating some of your time to building houses for the needy. This may be doing some free work for a single mom who luckily owns her own home but can't afford anything other than her mortgage payment to be able to pay somebody to fix her home. Do some community service, or at least know in advance what your policy is on that. Next is emergency jobs. This is really quick. I feel like emergency jobs, these are jobs where you need to stop what you're doing, leave this job, cancel the next job, or wake up at 2 a.m. and go do an actual emergency. Those should be billed, I think, minimum 2 times whatever your trip fee or your trip minimum is. You should be charging double if it's an emergency job. Now, urgent requests are a little different. Urgent means it's got to be done extremely soon, like today. But you don't have to stop what you're doing, and you don't have to cancel other jobs. For urgent requests, you can charge a little more for those if you want. I think you should, but there's not going to be any hard set numbers. Maybe you can call that 1.5 times your normal rate. And by the way, backing up on emergency jobs, 2 times your normal rate minimum, up to 3 times your normal rate, I think is still within a fair window. And finally, every single business is different. This video, the intent of this video is to break down sort of the industry and how things work so that you can go through and piece these together. I suggest that you go back to the beginning, download this PowerPoint. It's available for free. I already told you all how. It's at the bottom of the description. Click on the link. It's the very last link for my business documents, and you're going to find this actual PowerPoint in there. But you want to sit down and just go through these slides and rewatch this video and go step by step by step. Figure out what sort of structure you want. Figure out what your rates are going to be. Figure out what your policies on when you invoice, how long they have to pay you, or what payment structure you're going to set up. And you need to just take your time, guys, and you're never going to know in advance. I believe the term is, if you want to make God laugh, Tell them your plans, right? This business is not going to happen the way that you plan it to happen, but you still need to go in with a plan. So the best way to do that is just step by step through this video, come up with the most solid numbers that you can come up with, and then start off using those numbers and be ready to adapt as you go. So there is a masterclass at the moment. There should be a link in the description to take you to that masterclass. It's free. Again, no paywalls. I don't want your money. I want you to put your money into your family and your business, not into me. I will find brands that I trust, that I like, that I use myself, and I will get them to pay for all of this content, including master classes. But look in the description and go take that master class. It will take you step by step by step, from the very first step of just figuring out what the name of your business will be, sitting on the couch daydreaming about a business name, all the way through having clients and doing the work and getting paid. This masterclass will take you through every step. Right now it's in the description. You can click on the link. Eventually, bulletproofhandyman.com is going to become the masterclass, so you won't even have to go to like Thinkific and register. It won't cost you anything either way, but you won't even have to do that. So if you're watching this in the future, try bulletproofhandyman.com as well. Also, my downloads, I already told y'all, it's the bottom link in the description. I also have a newsletter. There's a link in the description for that. Sometimes it comes out every other week. Sometimes it's a month and a half. But I do put together very good newsletters teaching a lot more of these things and giving more solid advice, oftentimes geared towards the specific time of year that we're in. And then finally, guys, my affiliate links, as I just mentioned, no paywalls. I don't want your money, but it takes a lot to run this channel. This is like a full-time job on top of my full-time handyman business, and the way that I pay for the equipment and the way that I pay for the time that I take away from the business to put into this channel is by forming affiliate and/or ambassador relationships with brands that I truly and sincerely use, I trust, and I have used and trusted for a long time. I think they're great brands. I don't want you ever to purchase anything that you don't feel is the right product for you. But when you're getting started and you want to form your LLC, you want to get insurance, you want to get a CRM, and you need to start somewhere, go ahead and start with my links. And like I said, don't purchase if it's not right for you. I never want you to do that. But the way that you can help this project continue over time is, for example, go get yourself a 2-week trial of Jobber and just try it out. And if you don't like it, don't buy it. But that's how you can help me to produce more master classes, more educational content, and more on-the-job content for this channel so that we can all support each other. And last thing I want to say, I'm very proud of this channel, and I'll tell you why. Not proud of me. I'm proud of the channel and of the community. I started this off with the idea that this was going to be positive. This was going to be a place for people who want to start and run their handyman business to come and support each other and help each other. And that's really hard to find. I was on Facebook before and on a lot of other YouTube channels years and years ago. And one of the things I hated was there was so much bragging. There was so much people talking down to each other, telling each other they didn't know what they were doing, getting in fights and arguments. And you know what? There's almost none of that ever on this channel. It blows my mind because it was my goal. I don't know how I accomplished it. I don't think it was me. It has to be you guys. But we have a community here, a real community of guys who love each other and support each other. We all want everybody to succeed. We all want all of the other men in this field to be able to put their family in a financially secure position in a very permanent way for the rest of their lives. And this business is a great way to do it. So I love you guys. I hope you're all out there killing it, and I will see you on the next one.